As you're watching this, 6 o'clock in London, 1 p.m. in New York, 1 a.m. in Hong Kong, 3 a.m. in Sydney, 10 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world. My name is Patrick L. Young. The IPO-VID livestream Series 9, Episode 3. That is cumulatively Episode 51 starts here. One story caught our attention when we were talking to Bill Pazos. Record volumes. The Intercontinental Exchange announced that a record volume of environmental contracts traded in 2021. A total of 18 billion tons of carbon allowances were traded. That's equivalent to an estimated $1 trillion. $1 trillion in notional value and equal to over half the world's estimated total annual energy-related carbon emissions footprint. Now that brings us neatly to our guest, and he has a name which may be recalled by many who were on the streets of a gritty London in 1903 as an unrelated bearer of his name became a legend thanks to a news headline. Stupefied by the speed of the purpose-built bolides on the roads around Athy in County Kildare in Ireland, then still within the British Empire, the London Times newspaper simply ran the headline, "Gordon Bennett!" Exclamation mark. Nearly 120 years later, and here we are talking about emissions by automobiles and much else besides. Today's topic, appropriate enough, with ICE, we're on the road to a global carbon price. And our guest today, not to be confused with the long dead James Gordon Bennett, is Gordon S. Bennett. He's been Managing Director of Utility Resources at Intercontinental Exchange since February 2015. He's a member of the working groups of various issues, co-chairing the Sustainable Finance Working Group at ICE. He's a member of the board of ICE Index, a member of the board of ICE Futures Abu Dhabi, that incredible exchange that was built in only, 504 days. And he's basically responsible for pretty much everything that goes on in European and Asian natural gas and power within Intercontinental Exchange and that huge spread of emissions business that we've been talking about earlier in this show. Today, we're going to have in the studio once again as a guest co-presenter, Steve Zwick, the presenter of the Bionic Planet podcast. And it's a joy to have you. Gordon, where in the world are you today?
Hi, Patrick. I'm sitting in the leafy suburbs of Surrey today. And thank you for that wonderful introduction. That's my best intro ever. Thank you.
Well, there you go. I know a little bit about cars, and therefore it's a delight to see that beautiful picture of Steve McQueen in one of the very, very rare Jaguar XKSSs, which he owned just over your shoulder in today's show. Thanks for adding that. Gives us a bit of automotive color. So, Steve, greetings. How are you today?
I'm doing good. How about yourself?
Excellent. I am fabulous altogether. All the better for being here. So, Gordon, take us back a bit of a step. Tell us a little bit about your background, because originally you're an accountant and you were in the brokerage business, if I remember correctly.
Yeah. I trained as an accountant. Although I think I sort of got into energy off the back of my father was in the Merchant Navy. So I think that's where my roots lie in the energy markets. And then I went off to the fair city of Edinburgh to do a degree in chemistry. And I think that was me acquiring, if I'm being nice to myself, that was me acquiring my first option in terms of what I was going to do next. And as you say, I ended up becoming an accountant. And again, if I was being nice to myself, that was another option. If I was being a bit more truthful, it was because no banks would hire me. So I ended up training as a chartered accountant. So I've been in the financial services business really since 1995. And when I moved to Arthur Andersen in 1998, I've since then been focused on the energy markets. I was in the energy infrastructure and utilities group there, covering a number of clients, including Enron and also Spectron. And I took the opportunity that sort of presented itself around the Enron bankruptcy to decide to leave the world of professional services and go to the other side of the fence, and spent 13 years in Spectron between London, New York, and London again, doing a wide variety of roles. First of all as CFO, latterly as CEO, and as you say, I've been at ICE since 2015. So it's just coming up for my 7-year anniversary, actually.
Well, gosh, and one does hope it's not going to be a 7-year itch in your relationship with ICE, because things seem to be going so spectacularly well at the moment. So talk me through a little bit. I mean, how do you manage to go from getting into energy markets, being all around those sorts of things, and then also this move into emissions? Because obviously we're talking today about being on the road to a global carbon price.
Sure. Well, so I'm managing director of utility markets, and I suppose what does that mean? It's really the sort of the origin of the utility market portfolio is around the economics of electricity generation, and so that's really what do you use to produce electricity? You use gas and coal, and then we've seen the sort of advent of renewables. So the renewables complex is in that portfolio, and really when we saw the introduction of the European emissions trading scheme, that was effectively the birth of carbonomics. And so the organizations today who have had to deal with carbon price risk have had to account for their ton of liability is really electricity generators in Europe, and so that's why the environmental portfolio really sits within the utility market portfolio. It's all around the economics of electricity generation.
Excellent. Steve, you're on mute, I suspect.
There we go. Sorry about that. Yeah, I'm wondering if we could, because we're going to be looking at carbon trading within the energy sector, and I'm wondering if we could also talk a little bit or set the stage a little bit now for the role of natural climate solutions and how they might play out on an energy exchange, because they are so diverse, they are so much more complicated than say renewables, and I'm just wondering how you could, if you could explain how you see nature-based solutions fitting into the ICE platform.
Sure. So take a little bit of a step back in terms of why we looking at nature-based solutions. So net zero has two work streams for me. One is energy transition and changing the merit order of how we use energy, and the second work stream is effectively creating an asset class for natural capital for nature. And it's really all comes down to valuing externalities. So when we're talking specifically about nature-based solutions, when we're talking about carbon, we're really talking about valuing the positive externality of capturing and storing carbon. Now, how do you value that externality? There's different ways of doing it, and ICE, within ICE itself, we're looking at doing it two different ways. We've got the New York Stock Exchange and their announcement in September of last year with the Intrinsic Exchange Group, and that's really looking at valuing nature through a security, through an equity, in effect, creating a class of company called a natural asset company. I find that quite a cool concept, and the reason why I find that a pretty cool concept is that if you think about what an equity does, and I didn't really think about what an equity did until thinking about natural asset companies. An equity is just a pretty cool tool that allows you to measure the value of a heterogeneous asset class. So every company is different, but there is this tool called an equity that allows us to assess the value of each of those companies. And projects, nature-based projects, look similar in terms of that I wouldn't say that they're a homogeneous asset class. They're more of a heterogeneous asset class. And then perhaps an equity is a really good instrument to reflect the value of nature, of biodiversity. On the exchange side of the business, where we're more focused on commodity-like instruments, which lend themselves, not always, but mostly, to homogeneous products. We are looking to launch a nature-based carbon credit in the first quarter of this year. It'll be based on the Verra standard, And we're also looking at, so that's our sort of secondary market traditional futures tool. But we announced at the end of last year around COP, we said that we were going to start offering primary auctions. So with the goal of creating a more transparent primary marketplace, and our first customer that we signed up there was Permian Global, and we should be bringing those carbon credits to market during the course of 2022.
Okay. When you talk about because there's two things there. One is you're talking about the a nature-based company. And I'm wondering, I mean, that's such a big, broad scope. You've got mitigation banking involved in that, which are companies that do ecological restoration. Then you've got companies that are involved in providing support to agroforestry. And then you've got the companies that generate carbon offsets. And I'm wondering if you had different classes within that you'd be looking at in terms of floating equities on. And the other question related to that is, when you talk about the nature-based carbon credit, you're listing individual credits, right? Or are you talking about migrating towards some kind of an index built around that sector?
So our first contract in the nature-based credit will be effectively the Vera, a full loose standard, and it will come with CCB designation. So it's kind of like a vanilla strip. It won't be an index product, but we would plan to offer other types of carbon credits, whether those might be technology removals, or say a Corsair credit. And you could see a scenario where you build an index off of those underlying instruments in the same way that we've built the global carbon index at ICE, where we effectively have created a basket for carbon allowances, so permits to pollute. We combined with the ICE index organization, launched that index about a year ago. There's several ETFs listing against that index, and we could certainly, once we build liquidity in our underlying futures, you could see a scenario in the future where you build effectively a carbon credit index to go alongside our carbon allowance index, and then even aggregate those to give you this sort of global price of carbon index. And to your question on the New York Stock Exchange piece, that's sort of a little bit outside of my wheelhouse, but it requires a whole new sort of accounting framework, and it requires filings and so forth. So I'd say it's quite early days, and we'll be more transparency of the details behind that in due course.
Okay. Can I ask a quick follow-up, Patrick? Or
sure.
Did you,
Go for it.
Because if I could, I guess I should disclose I've been helping Vera develop some material, so I'm working with them. So I'm not completely unbiased, but I think they're a great organization. They are the leading standard-setting body in this field. They were originally called the Verified Carbon Standard, and they have multiple methodologies. Because I also worked with Ecosystem Marketplace for 15 years, working on the State of Voluntary Carbon Markets report. So we were always knee-deep in these offsets that are out there. And the biggest problem we always had in trying to come up with a single price on nature-based solutions is that they're all over the place, and they're also individual. They're also distinct. It's almost like a real estate market. You might have some kind of a general trend or something, but a project that works with indigenous people has so much more charisma behind it, and companies are willing to pay so much extra. We always had a real hard time coming up with a single price. We ended up settling on a weighted average that we could put out there and quote on an intermittent basis. So, and I guess the question that I'm going towards is, from an exchange perspective, there seems to be there's so many opportunities now to actually start to see order-driven prices for these individual offsets, individual projects, and within these prices, you could even see things like the co-benefit prices maybe being layered in, something like the value of an SDG co-benefit, the value of CB of a community climate and biodiversity certification. theoretically, that seems to me a really exciting direction to go in. But on the other hand, the prices are just so all over the place. They're so dispersed, and they're dispersed for real reasons. And I just can't. I'm trying to get my head around how some kind of a tradable index could work in a kind of a system like this with so many different projects that are so unique to their geography, to their type, and everything else. Is this, or is that just something that's going to have to play out over time? Am I just
No, those are all good questions, and they're all fair observations. But what we're trying to do here, we're effectively trying to build a benchmark contract for carbon credits, in this instance, a nature-based solution. And so you don't have to have a precise tool to build a hedging instrument. On quite the contrary, and what happens in markets is that there are very few benchmarks in the world, and because people value liquidity over basis risk, so people would rather have deep liquidity rather than the most precise hedge, because if you can't get out of your hedge, then it's not particularly useful. So there's always a payoff between liquidity and basis risk, and if you want to be precise, then you can always go OTC, like people do in other markets today. So yeah, if you want to buy a particular carbon credit with 3 or 4 SDGs that matter to you, then you will go to a seller that can provide you that. But if you want a hedging instrument, then you can be less precise in providing it. I think that, whilst on this point, is maybe worth taking a step back in terms of, what's the purpose of financial markets. And when I set up the Sustainable Finance Working Group at ICE, I find myself asking the question, okay, what is sustainable finance? But I had to take a step back because I had to figure out what the purpose of financial markets first. And despite spending my entire career in financial services, I didn't really have a good answer for it. And from my perspective, where I landed on was the purpose of financial markets is to allocate capital into transfer risk, and valuation is at the core of those. And going back to my accounting roots is something called the fair value hierarchy. And quoted markets like the New York Stock Exchange or the ICE derivative marketplaces are quoted markets. Now, why do they sit at the top of the hierarchy? It's because they're the most precise measure of value, and the more liquidity you have, the more precise you are, because the narrower bid offer and the deeper market you have. And why are they most precise? Because people execute on these prices, they allocate capital, and they transfer risk on these prices, and they effectively smooth their earnings. And why is that important? Because if you are an organization that can smooth your earnings, you tend to attract a higher multiple from the investor community, and it also allows you to get more forms of capital and cheaper forms of capital, which allows you to grow your organization and effectively grow the real economy. So we're in we're providing a service. We're basically a valuation engine that's allowing people to allocate capital and transfer risk, and you need benchmarks for that have a wide group of buyers and sellers to generate that liquidity. And as you say, what will happen is if someone has a more precise demand for a tool or a commodity or a security to buy or sell, then they can get that, but they're going to do that off exchange.
Very interesting. Okay, so we've got a situation where you're looking at what is a financial market. It's to allocate capital and manage risk. You talked about the fair value hierarchy, which I think is very appropriate here. But just a second, we're 2 degrees away from that, aren't we? Because, I mean, talking about the smoother earnings profile from cheaper capital, etc., very appropriate, managing risk, etc., transferring risk transfer is important. But surely then there's another step, isn't there? I mean, sort of what is a commodity market and what is environmental markets and sustainable markets?
Yeah, no, absolutely. And so environmental markets moves you into the world of sustainable finance, which is really about valuing externalities. So financial markets is really sort of driven by economics. Sustainable finance is about allocating the value and the cost of externalities, and they can be positive or negative. And that's the purpose of an environmental market. It allows people to determine the value of a negative externality, like the cost of pollution. And so a carbon cap and trade scheme is is a vehicle that allows us to determine the negative externality of pollution. And then on the flip side, on the positive externalities, you could either have renewable energy credits. That's effectively the currency that lets you know what the value is of the positive externality of generating clean electricity, not polluting. So that REC is a green attribute and it has value. And then when we're talking about nature, we are valuing the positive externality of capturing and storing carbon, so taking CO2 out rather than pumping CO2 in. So yeah, that's how environmental markets come in, and how it sort of changes the dial from traditional finance and economics to sustainable finance and carbonomics.
Okay, so therefore, carbonomics is the economics of the world that has been essentially modulated through a carbon lens. Is that right?
Yeah. Yes. Absolutely. It's we're basically valuing. I say we're valuing things that we weren't previously valuing. But having said that, the European ETS has been around for 15 years. So there's been a group of companies that have been exposed to carbon pricing for 15 years and have effectively had tons at risk. What is going to happen over the course of the next 2, 3, 5, 10 years is increasingly more and more companies are going to be exposed to carbon pricing. They're going to have tons at risk. When companies are making net zero commitments, they're reducing their emissions profile, and they're also saying they're going to compensate for that carbon liability. So basically, more and more carbon tons at risk are going to have to be risk managed.
Very interesting. So when it comes to this risk management, that starts to become very interesting to me, Gordon, because obviously you already have a suite of products which offer a wide variety of things in the energy side of the business. Then you've got this suite of products you're developing in the carbon side of the business. Where do those two actually meet in the middle, or do they meet in the middle?
Yeah, they absolutely meet. And the thing is about environmental markets is that they don't work on their own. They work in relation to the energy markets. And so the best example of carbonomics at play is really right here in the UK in the electricity generation sector. So as it stands today, the coal has largely been removed from the electricity generation sector in the UK, and that's been through the application of carbonomics through cap and trade by putting a price on CO2, and also a little bit of policy intervention by the UK, unilateral policy intervention, because when post-financial crisis and carbon pricing was low, we're probably talking 3-4 euros, even applying a carbonomic model didn't change the merit order between coal and natural gas. So the UK basically said, what price of carbon do we need to move coal out of the merit order? and they introduced something called the carbon price support mechanism. So it was effectively a top-up. And this top-up was introduced in 2013, and since then you've seen this reduction of coal-fired generation. So what happens is if you apply traditional economic model, coal is cheaper to burn than natural gas, and so your models are telling you to burn coal to generate electricity. But because coal is twice as carbon intensive as natural gas, if you start applying a robust price of carbon, you invert the merit order. And in fact, not only is coal becomes more expensive for large swathes of time, if you were generating a megawatt hour through coal, you'd actually be losing money. And so, hey presto, no one invests in coal, they shut down their coal plants, and you sort of meet the policy intent, which is to abate emissions. So that's how the sort of the energy markets and the carbon markets work together. It's changing the spread relationship and changing the merit order.
So that gives me an instant kind of spark spread, because
Yep.
presumably, I mean, there are all of these sorts of amazing different spreads that we get in the world of energy futures. How do those then relate into the world of carbonomics and emissions-based product?
Yeah, well, that's perfect, because yeah, the spark, it is the traditional way of talking in the sector. The gross profit margin to generate electricity through natural gas is called the spark spread. Through coal is called the dark spread, and when you apply the carbon cost, they're called the clean spark spread and clean dark spread, respectively. So it's that interaction between the clean spark and the clean dark that is changing the merit order. And I think Bill Gates does a good job in his book How to Avoid a Climate Disaster. He talks about the different uses of energy, and he calls electricity generation how we plug in. Is that sort of quite a good layperson speak in terms of what we're using electricity for. And he also introduces this term called the green premium, and the green premium is effectively saying that greener technologies are more expensive, and to therefore allocate capital to the new stuff, you need to erode that green premium, and you erode that green premium by pricing externalities. And so if I could give an example, if you read something like a Lazard's levelized cost of energy report, what that does, it tells you how much it costs to build an energy asset, whether it's a coal plant, a gas plant, a wind farm. It effectively takes the total cost of the life cycle of the plant and divides it by the total number of energy that plant is going to produce, to give you a levelized, what's called a levelized cost of energy. If you start applying the value of positive and negative externalities, what you do is a coal plant and a natural gas plant, by allocating a cost of pollution, is going to have a higher cost, and so it's going to have a lower net present value than it would under traditional economics. And also, if you look at a wind farm from a positive externality point of view, by valuing the green attribute of the renewable energy certificate, you're adding extra revenue to the wind farm, and so increasing its net present value. And so those externalities start changing where you can allocate capital. And the markets, environmental markets, are allowing us to, or hopefully providing signals to move dollars from here to there. Now you can also do, there's lots of other types of policy interventions, whether taxes or subsidies, but they're all designed to move the capital allocation effectively.
Steve.
Yeah, I've got, you touched on a lot of issues that are really current in the carbon markets. You talked about the green premium and the need to put money into these into next generation technologies. And that kind of gets into this whole issue of reductions versus removals, because, from the perspective of the way the markets have existed, that would be considered a reduction. You're putting money into projects that reduce emissions, but eventually we have to go towards projects that actually extract emissions from the atmosphere, in especially carbon capture and storage. And one thing we saw in the latest State of Voluntary Carbon Markets report was that the price premium on on offsets that are generated by removing greenhouse gas increased about 5-fold compared to the increase in reductions. So I guess there's two questions. One is, if you could, we should probably just quickly differentiate between compliance markets and voluntary, because I'm kind of talking more in the voluntary direction. You're talking more about the compliance markets, where there is the government imposes a mandate that you have to move towards, and a lot of times you're paying for allowances, or which are the permission to pollute, as you put it, and then within that you do have offsets. But then in the offsetting side, the cost of offsetting for reductions or for removals is going up really, really high. And I'm just wondering, again, from the perspective of an exchange, how do you manage this? How do you deal with these different gradients out there, or do you just kind of assume that, kind of lump them together and let the market sort itself out? Because, you know what I mean?
Yeah, I do. There's a lot in there. So yeah, I agree that we need, and my point at the beginning in terms of net zero to work streams, getting a value for nature, is very much about that's about capturing and removing tons. That's the asset that we have the most supply of today, that performs that sort of carbon capture and removal service, and it's integral that we put a value to it in order to meet net zero. I think it might be very difficult to meet net zero without it. We need to attribute value to preserve nature rather than extract it. When you're moving into sort of tech-based carbon removal tons, like you were talking about, carbon capture, utilization, and storage, there just isn't a lot of supply, right? So there's supply, but it's not at scale. And you're exactly right. We need to find ways of incentivizing investment in whether it's CCUS or direct air capture, and that all comes down to my previous point about effectively levelized, I guess it's levelized cost of removal. Maybe that green premium needs to be narrowed, and part of that will be through valuing a carbon removal ton. But I suspect that you're going to need to have government intervention and subsidy, like there was in renewables in the first instance. If we go back however many years, the cost of renewables was extremely high, and the cost curve has come down very quickly, and I think far quicker than anyone anticipated. And so the cost curve is going to come down, but I think that there's going to have to have some level of subsidy to de-risk investment in carbon removals. But I think it's in terms of the standardization of a carbon removal from a tech-based removal, then that's going to be an easier win than nature. The challenge for nature is, how precise can you be in the measurement of the sequestration of that ton of carbon. I think that's quite difficult, and perhaps is holding back investment towards nature. I think about carbon removals a little bit like the opposite of a renewable energy credit, which is not an offset. A renewable energy credit is the certificate that proves that you didn't emit any carbon, so there's nothing to offset. But the key part about a renewable energy certificate is it's metered in, so you know the megawatt hours you put into the grid, and for every 1 megawatt hour you put into the grid you get 1 REC. I think that a carbon removal will be almost be the opposite of that. It'll either be metered out, so you know the ton of carbon that you've removed and stored through your CCUS, or it'll have a pretty clear scientific based methodology that will be objective and not be subject to any sort of subjectivity around measuring that ton. So I think on the tech side, we'll be in a good spot in terms of measuring the ton. We just need to get dollars to go to those forms of technology. Nature, something needs to be done in terms of the precision of measuring that ton of carbon that's been sequestered, if that makes sense.
Okay. Mm-hmm. Yeah. Another issue that's huge these days is green hydrogen, which is essentially using renewable energy to create the hydrogen, and then essentially using hydrogen as a store of energy. It's essentially a store of renewable energy, but I'm wondering if you've given thought to how green hydrogen will play into the energy market as a separate commodity alongside oil and gas.
Yeah. Well, there's certainly a lot of there seems to be a lot of policy support for hydrogen, and that's moved quite quickly over the last 12 to 18 months. Green hydrogen's a little bit difficult conceptually in that you're taking electricity to create hydrogen to effectively, power fuel cells. So there's a whole host of inefficiencies in that process, and so it's extremely costly. So, but I think you hit the nail on the head. The important concept around green hydrogen is more around the storage. I think if you only look at green hydrogen in terms of the production cost of green hydrogen, I doubt that ever gets in the merit order unless it's very heavily subsidized. But the green hydrogen is effectively a store of value of your electron that's generated from renewable electricity. So it solves somewhat for intermittency. And sometimes when wind and solar is being produced, there's an oversupply, and so you're not really utilizing that asset. By electrolyzing, you're effectively using that asset better. So effectively, you're going to increase the net present value of your renewable project by going down a green hydrogen route. So it's the whole capital allocation, the whole net present value of a green hydrogen project has to be linked to the storage aspect of it. As far as what that will look like in terms of a market, I think it will look very similar to other markets where you unbundle the commodity from the attribute. And so hydrogen will trade as a commodity, and there'll be various attributes that are associated with how you produce it. So whether it's blue hydrogen or green hydrogen, at the end of the day, I think green hydrogen is basically hydrogen with a renewable energy certificate. So you could argue we've already got the tools in play that allows you to value green hydrogen because we've got the REC. The hydrogen market on a standalone basis today doesn't really exist. Hydrogen is used. It's grey, but it's not used extensively enough where it maybe warrants a benchmark hydrogen market. Grey hydrogen is effectively the steam reformation of methane, and so hydrogen today is effectively natural gas. So if you did want to hedge it, you'd hedge it with, say, TTF.
Very interesting. So therefore, okay, we have a huge cornucopia of possibilities. I mean, I've all gone into this cauldron of environmental products. Let's just call it that very briefly, all around the carbon base. We've got the whole concept of hydrogen-based stuff, etc., etc. Now, where are we in terms of then, are we headed towards managing to get a single carbon price? I mean, we said we're on the road to a global carbon price, But does that actually come out as one single price in the end, Gordon?
That's a very good question, Patrick.
That's why I asked.
It would be great if we had a single carbon price, and the way we would deliver a single carbon price is through a global cap and trade program. And because the great thing about a cap and trade program is, although you get a price out of the end of it, you actually control the quantity of emissions. So, you know, if you emit, you have to go and acquire your permit to pollute. If you don't, then you get fined, but you don't get off getting your permit. You still got to go and find it. So you either need to go and get the permit from somewhere else, or you effectively have to abate. So it controls the quantity of emissions, and carbon cap and trade is really, as far as I can see, the only tool that controls the quantity of emissions. The other great thing that a cap and trade does is it allocates the ownership of the ton. So, you know, it's a polluter pays model. You know who owns the ton, you know who has to account for that liability and buy that allowance. You know, we got fairly close to a sort of a global price of carbon under phase 3 of the EU ETS, because there was something called the Clean Development Mechanism, which was basically a UN mechanism to value project-based credits, like we were talking about earlier today. It was Steve on, you know, they're now called sort of voluntary carbon markets, but there was a UN program called the CDM, and the currency of the CDM was a certified emission reduction. So when people are talking about voluntary carbon credits today, whether it could be a VCS or gold standard or ACR or CAR, the CER was effectively an equivalent of those. And the European community, the European Commission under the ETS allowed compliance entities in Europe to buy CERs to meet part of their compliance obligation. So it was, say, 10%. If you emitted 1 million tons, you could buy 100,000 tons of CERs. And so what did that do? It immediately created a demand pool for these project-based credits, but it linked its value to a liquid compliance market, and so they traded as a spread. So, you know, you effectively had one price because the pricing was linked to the compliance ton, but it was linked to the compliance ton because it was allowed to be used. That decision was then reversed under phase 4. So we're living in a world where it doesn't seem like there's a big opportunity to link a carbon credit to a compliance ton. So it's really the industry corporates are going to have to, we're going to have to build a sort of a price for an international carbon unit through something like the voluntary carbon market, because I think we're going to have to wait a little bit longer to see Article 6 come into action. Although we got a good result out of COP26, I think we're a few years away from Article 6.2 and 6.4 coming into action. So therefore, it's basically commerce, or what's called the voluntary carbon market, is going to create a price for these project-based credits. So, you know, I don't necessarily see there being one price, but increasingly the prices will become more correlated, I think.
Okay.
It'd be interesting to hear what Steve thinks.
No, I agree. I don't see, you know, the idea of a core carbon price, and we talked about it all the time in the task force and scaling voluntary carbon markets, and I just don't see how we can. I can see how we can have reference prices for certain subsets, but, you know, I agree with you. I just, in theory, there should be a price of carbon, but the variance is just too big on the ways, you know, the way the markets or the markets work. I had a question. If you, let me know if I'm getting too speculative on this or too philosophical, but the interesting thing is the next generation beyond carbon. I kind of alluded to it at the start. You know, there's a sense out there that we have lots and lots of other environmental assets that could benefit from some kind of a reference price and face the same quandary that we have in the voluntary carbon markets, which is, they're not standardized, which is things like water allowances, water quality allowances, biodiversity offsets, things, and SDG based kind of assets. Vera and the Gold Standard are both coming up with ways of quantifying certain SDG attributes, and there seems to be a lot of academic excitement around this idea that each of these could all benefit from an order-driven system that could provide a global price, and then you could really unpack these markets, as you were talking about before. One of the problems we have right now is that the projects are also different, and is it possible to have these additional attributes traded separately, quantified in a way that's verifiable, and then use that to build, ways of adding to and subtracting from a global carbon price?
Yeah, okay, let me try and unpack that. There's a lot there.
Sorry. Yeah.
So first of all, I think we haven't solved for carbon yet. So we need to solve for carbon first. That's the biggest sort of danger. That's the biggest risk that we need to manage, and we need to solve for that first. We need companies need to start accounting for this risk, and many are, but a lot more are going to have to start sort of recognizing liabilities. These are not, I know you referred to sort of charisma. It's not about, I know that people want to make sure that, good things are also done with these projects, but ultimately this is about compensating for your carbon liability. And so we need to solve for that first. And then as far as other stuff is concerned, we'll see. Not everything needs to have a quoted market to determine its value. So, I talked about the fair value hierarchy. There's 3 levels, and in my career, both sitting at a brokerage house and in a futures exchange, many people have come to me and said, "Oh, I need to value this. Let's launch an OTC product, a swap, a physical delivered product, or a future," thinking that the be all and end all is a quoted market to determine value. Some things don't lend themselves to being on a futures market, and so you have to come down the fair value hierarchy to determine its value. And so I think my main point there is not everything needs a future to determine its value. I know you touched on water a little bit. I know there's water is. I've been asked a question about water before, and actually, the previous point I made around people saying come and launch a market, let's build a product here. Sort of the first thing I always ask, is it intermediated? Is it brokered? And there are actually brokered water markets. It's in Australia. I think the challenge with water is the sort of the cutover between public and private good. I suppose you could argue that it's the same with energy, but I think water is probably more closer to a public good, and therefore having a private market solution to it might be more challenging than it is for, say, an energy market. And if I missed anything, you can re-ask me.
I think Patrick's.
I think at that juncture, probably I'm feeling a little bit like the child from the Far Side cartoon. My brain is full. It's certainly been quite an incredible discussion so far, and there's so many elements to this. It's clear that the whole product set is going to take a long time to run and run. So, Gordon, I'm very, very interested to hear from you. Where do you think, well, we always lend ourselves the capital market revolution appendage for some reason at this juncture. Where does the capital market revolution go next for you?
Yeah, so we've launched quite a lot of products over the cusp of the year in the renewable energy certificate space, and so there's almost an insatiable demand for people to want to buy renewable electricity. That renewable energy certificate is how you prove that you bought that electricity. When we're taking electricity off the grid, we're taking whatever's in the grid. So the only way to prove that you've bought clean electricity is through your certificate. So there's going to be increasing demand for renewable energy certificates, as well as renewable PPAs, and so we invested in Level 10 at the end of last year, which is a PPA marketplace and data provider. We launched a series of renewable energy certificates at the end of last year, and today we've launched 6 more renewable energy certificates based in the US. So we've built out our US renewable energy certificate portfolio. We will be looking towards Europe next to build out that portfolio. And then we're going to dive deeper into providing valuation services around the positive externality of carbon capture. So whether that's nature-based credits, Corsair credits, carbon removals. So we want to build a portfolio that gives people access to value as many positive externalities and negative externalities as they need to sort of navigate this move from economics to carbonomics.
Mm-hmm. Oh, Patrick's muted.
We've been navigating our way through the positive externalities and these negative externalities and trying to find a way towards something which is a holy grail, but clearly isn't actually likely to lead us to one single carbon price, if I understand correctly. But at the same time, we're going to end up with, ultimately, when we can solve for carbon, we've got the opportunity to solve for a series of other things, Gordon.
Yeah, I think that's exactly right. But solving for carbon is harder than it sounds. One other launch that we have coming up in January, that sort of fits that global price of carbon narrative, Patrick, is we've got. I talked a little bit earlier about our global carbon index and how that's being used by various ETFs, particularly in Asia. We're going to launch a global carbon index future at the end of January. And so when I talked about earlier about more organizations being exposed to carbon pricing and having tons at risk, that could come in the form of a pre-compliance entity. So the European ETS is through Fit for 55 is effectively going to double in size in terms of the sectors of the economy that it's going to cover. And also, all of these voluntary commitments to net zero, people are going to be putting tons at risk. This index future is actually a pretty good tool to effectively have exposure to carbon pricing. If you thought that carbon pricing was going to go up, then you could buy this index future, and sometime in the future, if you were then in a compliance scheme or you were looking to buy carbon credits to compensate on a voluntary basis, you could sell that future, and you effectively created this pool of investment that you could then invest in either a carbon credit or a carbon allowance. So this is a pretty cool tool in terms of being able to have a view on carbon pricing, to manage a future risk to carbon pricing through one basket of carbon allowances.
Yeah, I've got a quick question that's related to that, because when we talk about carbon pricing, there's the idea of having a high carbon price to drive change, which is the Nordhaus model, and then we've been talking about the voluntary carbon markets, where you're trying to find the most cost-effective mitigation tool. And there's a new trend towards something like soft carbon, where we're starting to see projects that are next generation, such as investments in certain blue carbon components and things like this, where there isn't all this verification and validation like you get in a carbon market, but there is a need for some kind of finance, but without an offsetting claim. And I'm wondering if there is a role for exchanges in helping to kind of navigate this, to steer funding into this next generation to really drive emissions down quickly. Or is that something that's only going to have to, is an exchange only going to be involved in the stuff where you have verification, validation, and standards already in place?
Yeah, we couldn't get involved in something whereby you didn't have a robust sort of delivery mechanism. That I suppose the challenge with all of these is they're effectively intangible. They're pieces of paper, and there's a transfer of ownership. And so if you don't have any accreditation, then that's never going to find its way onto an exchange. I think the irony is that there's so many standards out there. There is no standardization, and you know, that's been a common theme through this chat. That's definitely a challenge. That there's such a low barrier to entry to set up a standard and methodology, and I think that's something that the market, if it wants to sort of institutionalize, which I think it does need to institutionalize in order to allow dollars to flow to it, then, you know, having another plethora of standards and methodologies it isn't going to help get to an efficient outcome. So I'd imagine, you know, some of these soft carbon, as you talk about them, then you know, standards will evolve there. But until they do evolve, then an exchange isn't going to be sort of involved in those types of markets.
And that leaves us, I think, on a fascinating point, because we have a problem in that everyone has their standards, but actually we are lacking a bit of standardization, which is therefore, well, causing us to continue the journey on the road towards a global carbon price, along with the Intercontinental Exchange. And indeed, Gordon S. Bennett, who's the Managing Director of Utility Markets for the Intercontinental Exchange. I think that's been an absolutely scintillatingly fascinating discussion through all manner of roads as we try to make our drive towards a global carbon price. I want to say thank you very much, Steve Zwick. Thank you very much to the production team, everybody within that, Natalie, Jamil, and Micah, and Beata. And also, finally, the last word I have to say is, what else can we say after such an illustrious and incredible discussion today? Gordon Bennett. I've certainly been surprised throughout the course of the conversation, Gordon. Thank you so much for that. My name is Patrick L. Young, wishing you all a fantastic week in life and markets on behalf of myself, Exchange Invest, and indeed, for the final time, we're wishing you, probably, depending on the EGM on Thursday. Watch this space, ladies and gentlemen. Have a great weekend.